And we're live. Good morning, Jeff. How you doing?
Good morning. I am doing really well. How are you?
Very good, thank you. Very good. I just got off
Yeah.
a call with a super high-profile strategic that I can't name, made an offer on one of our deals. So fittingly, what are we
So you're
talking about
buzzing.
today? Yes, I am.
You're buzzing. Yeah. I'm on coffee number, I don't know, whatever. I had a bit of an early start today with calls that were overseas. The perils of being on the Pacific time zone when you try to reach people in Europe or whatever. You sort of want to be respectful of their working day and not push things too far into the evening, which means an early start for me. But with a 21-month-year-old running around, it's or 21-month-year-old. Did I really say that? 21-month-old baby running around who likes to get up fairly early. It's kind of whatever.
It's all right.
Use that. Yeah, that's fine. I'd be lying if I said I wasn't up anyway.
Yeah.
Yeah. People are like, "Oh, you must be a morning person." I'm like, not by choice, but yeah.
Man, I'm getting up at 5 right now, so I guess I am a morning person. I like that quiet time in the morning just to get shit done. It's kind of good.
Yeah. Well, different strokes.
Yeah, exactly.
Yeah, there's no quiet time if I'm getting up at that early anyway, so all good.
Awesome.
All good.
So what are we talking about today? What's the topic?
Well, this is interesting because this is obviously on everybody's mind, and it's a question that sort of comes up often, and I guess it's probably overdue to sort of make a segment on this, but talking specifically about how COVID has changed things, I guess, and specifically to like higher value deals, I guess, is where we should narrow this down. Is it like, how has this affected and how has this changed 8-figure, say, deal sales? Like what, obviously different things like debt facilities and access has changed. What are lenders doing, I guess? So I guess if you want to sort of introduce the topic a little bit, I've got, I want to dig into this. I got lots of stuff to sort of pick your brain on. So if you want to sort of set it up and what your sort of general thoughts are, I'll and of course, if anybody has any questions, we're live, so feel free to pop in and leave a question, and we'll get to it.
Yeah, absolutely. So I thought it'd be cool, and like you said, it's overdue, but specifically to talk about 8-figure exits. So different tiers of business value have different buyer pools, and different buyer pools are being impacted by this situation very differently. So we have a number of 8-figure deals we're working on right now, 3 actually. So it's kind of juggling at the one time. So we've got a bit of perspective, but we've also been talking to other M&A advisors in this range and above as well. And so I think it'll be interesting to talk about what actually goes into these deals and all the moving parts and how that's been evolving over time and how it's even changing as we speak this week. So yeah, so maybe let's start with that as far as what does it take to get an 8-figure deal done. So ideally, as it always people just with $100 million in their bank and they're just cutting checks direct from their account, that would be great. And sometimes that is the case. However, more likely than not, there's a component of debt being used. So they're working with lenders basically to help fund the deal. This improves returns, very similar to real estate. If you're buying a large office building, chances of you using 100% cash are pretty low, right? So this does add a layer of complexity in the current market. So we had a deal happening right as the markets changed. So as all this COVID situation happened, the markets took a dive. What was happening there was the buyer on this one particular deal was looking at 3 acquisitions at the same time. They'd already signed the purchase agreement on one. We were working on our purchase agreement, and the third was getting ready to get started. That buyer was using, they were a private equity group with capital. So they had committed capital, they had funds ready to go. They were wanting to use a mix of capital and debt. They'd raised the debt, they'd done the diligence on our, 2 of those 3 deals were ours, by the way. So one of them we'd done all that diligence with their lender, so it was ready to go forward. Unfortunately, their lender pulled out of the deal, even though they'd already vetted the deal. So the buyer was left with capital. They had enough capital to acquire both, but they chose to pause one. So when a buyer has access to capital and they're wanting to use that, this can change the environment pretty significantly. That deal is still valid, but it's on pause. So that's one scenario we've got to talk about.
Got it. So lenders are getting spooked, not necessarily the buyer themselves. So I think if I remember you talking about that deal on another episode, it was the seller still wants to sell and the buyer still wants to buy. So the appetite to make the transaction happen has not changed. It's just with the lending facilities or whatever that they've sort of decided that the uncertain future of things was enough for them to say, even though we like this deal, we need to hold off.
Yeah, exactly.
Right.
Yeah.
And has it slowed things down significantly? Like, have you seen things taking longer for people to want to raise debt to buy a business? Is that sort of taking longer now? Do they need to, like, because we've talked a lot about, yes, you want to sell your business, but the person who's buying the business, if they're raising debt, also needs to sell it to potential investors. So is that piece of the business taking longer? Are people just sitting back a little bit saying, well, let's take a closer look to really be selective here?
Yeah, so it depends on the buyer type. So there are e-commerce buyers, portfolio buyers that already have debt facilities in place. So it's essentially like cash. They've already raised it. They're ready to deploy. They're still active. What we're seeing with their offers, though, are they're becoming more buyer friendly. So essentially what that means to you if you're trying to sell your business is less cash at close. The number one reason they're doing this is to improve returns, right? They know there's less buyers that can pull the trigger right now, that have that capital ready to go in general terms. So they're taking advantage of the situation, as they should, as good investors would right now. So that's something to keep an eye out for, but they're not the only buyers. They're not the only buyers. We have many other buyers that we're talking to. There's another deal that is in a bit of limbo right now that I'll talk about as well. So this is another 8-figure deal. The business itself is absolutely booming. Year over year, they're up like 500% at the moment. So we have a floating deal, meaning it's the trailing 12 months when we can close the deal is what the multiple will be applied to. So this has gone up significantly. We're talking millions in the past month alone in value, right? This deal is floating up because it's taking longer to get the deal closed. So that's one piece that we've used to ensure upside value for our clients. As you know, we're sell side, so we want to maximize what our clients will sell for, and it's mutually beneficial. With that buyer specifically, they are highly strategic. They have immense distribution and even supply side manufacturing capability to bring to this deal. They want this deal. They have equity, so cash to bring to the table, but they also need debt. They're going through multiple scenarios right now to figure out the debt, but essentially in the beginning, once we signed and once they were looking for debt providers, it was crickets because all of this had just happened. The markets had turned. The good news is it's now becoming clear that lenders are starting to get more comfortable with lending again and interest in doing deals. The seller, because they are a strategic, they have a buy-side advisor. So I'm talking with them almost daily at the moment, working on this deal together to get it closed. And they have a ton of M&A experience. They're saying they've actually paused a couple of their sell-side engagements because of the trouble getting funding. They've actually delayed them by about 60 days just to wait for that debt to be flowing again so they can actually take these deals out. The deals they're looking at taking to market are between the 30 to 50 million range, so right in the mid 8-figure range. There's definitely debt that's going to be applied to all of those deals. So they're very keen to do the deal, of course. that everyone wants this deal to happen, but getting the lenders to actually sign right now on that specific deal is taking longer than we would have liked. But the strategic nature of that buyer makes this a home run. They can add a lot of value immediately to that deal.
Just I wanted to point out something you said a moment ago about less cash at close. Now, just to clarify for people, that doesn't mean that they're selling for less or the value of it is less. It's just less cash at close. Yeah. But what are you seeing in terms of that? Is that a trend now where they're starting to sort of peel back what they're offering upon signing and sort of attaching some of that stuff to future performance, like on an earnout, or just a holdback in general that may not be necessarily based on performance? But are you seeing a general trend of less cash being offered at close because of COVID?
Yes. Yeah. Okay. So I think across the board, and the reason for that is because they can, right? A buyer can offer whatever they want. What we're mostly seeing is the multiples are still strong, but the deal structure is actually changing on the first pass of an offer. And everything's negotiable, right? So you don't need to say yes just because that's what's on the table. We're actually getting a lot of sellers coming to us checking on direct deals right now. Jeff, you've had a bit of this over the past couple of weeks here, where these Sharpie offers are coming in, and they're saying, well, is this a good offer? Should I take it? What else is out there? And there's definitely more buyer appetite. But what we're doing is we're filtering and negotiating harder on the deals that are coming in, specifically in the 8-figure range. You know, we're still seeing big multiples applied, really strategic buyers, but the deal structures are either having to change because of the debt, slower to raise debt, or just in general terms, they're saying, well, we don't need to offer as much cash at close to get this deal done, maybe to improve returns. But that means, like you mentioned, it's not saying that the deal value is less, it's just when you get paid. So there's usually, in most 8-figure deals, there's usually multiple pieces to get to that top line valuation, multiple number that we're talking about that we negotiate. So one piece is cash, and that could be cash at close or a delayed payment over a period of time. There's usually a seller note involved, which is a piece of the deal that you're taking on as debt, so you become the lender. And then there's a portion of equity, so cash that the buyer's putting in, and then a debt provider coming in as well. So there's multiple pieces to these deals. As far as when you're actually getting paid, the total amount could be over a number of years in most of these deals. So this is again why you can look at multiples or top line all day long, but it's actually what the deal breaks down to that really matters.
Yeah. I like to tell some of the people that I talk about when they get hung up on multiples, to say, like, consider multiple a result of the deal.
Yes.
But rather than a target that you're trying to achieve, because the higher the multiple, the more complex the deal structure might be. So it doesn't tell the whole story. But you've mentioned a few different types of buyers in the last couple of minutes, and maybe we want to break that down kind of into segments. So you did sort of mention some predatory offers out there, but who are they coming from? So let's talk about like the cash buyers for a moment. How are they operating right now specifically?
Yeah, so cash, when we talk about cash buyers in the 8-figure range, these are mostly e-commerce portfolio buyers. So there's a huge range of these type of firms out there that are looking to buy as many brands as possible. Most people think there's only 1 or 2. There's 50 to 60 at this point. We're getting 3 a week coming through right now. Or more, sometimes daily. It's insane how much money there is for, and how much appetite there is for this multi-brand approach. So there's a lot of these portfolio buyers coming out. They have the capital, so they're positioning as a cash buyer. What they're wanting to do is pay as little as possible up front and push out the rest of the payment as long as possible. So they're typically really low in the 2x, 2.5x range as far as a multiple of cash flow, even up to the 8-figure range, mind you. That's at close, and then pushing the rest of the deal value later, usually using a performance-based earnout as far as you share the future upside of the business. The problem is you don't control the future of the business because you're out. They've taken over now, right? So there's a lot of risk that a lot of sellers are taking on. They think, oh, this is a larger business, they have infrastructure. Maybe they can do something with the deal, maybe they can't. I know for a fact a lot of them aren't focused on increasing the value of an individual brand. They're looking as a portfolio. They just want to stack as much revenue and cash flow as they can to have a bigger exit. They don't care about your brand, right? So that's
they are buying risk, right? Like if you peel it back to its most basic form, they're buying future risk from you, you know? So the more they can push back on you, the seller, the better it is for them. But that's going to be more of a buyer-friendly structure than a seller-friendly structure. That's where your broker really needs to play an important role there as part of that negotiation. Because as you say, everything is negotiable.
Yes.
And buyers can ask for whatever they want. But it's up to you to decide what you're comfortable with and what you're not comfortable with, and have those discussions. So that's great. Now let's talk about strategics for a second, because obviously, you know, that's a goal for a lot of sellers, is to get with a strategic buyer who's got a strong plan for their brand, whether that's even buying up their market share or adding their products to their existing line, or whatever their strategy, i.e. strategic plan, would be for their business. But typically strategics have distribution channels in retail and some other things, and some of that stuff, some of that flow is stopped right now because of COVID and lots of store closures, and that has been interrupted. But are they still active?
Yeah, absolutely. And I think the buyers with a retail channel right now are even more interested, because if they have retail distribution across the US, let's say they're in 300, 3,000 stores, whatever it might be, they have that distribution ready to go. With the consumer behavior changing to being more buying online, they're more interested in e-commerce and getting a foothold in the virtual world, so that when the stores open back up, they have both sides covered, right? So that's what we're seeing, is a lot of appetite from retail heavy investors or backgrounds, distribution channels, to looking online. There's more and more of them coming across with that massive distribution angle in their pocket. They're not slowing down. If anything, now that some of the stores are starting to open back up, they're more bullish about buying online brands than they were in the past, because they've seen the consumer behavior change. It's been pretty significant. But
category dependent, though.
Yes, 100% depends on the category.
Yeah, that's not a blanket for every little niche. So that's yeah.
There's a couple of categories right now that just we're all waiting for these to come back to life, basically. So if you're unfortunate enough to be in some of those categories, I feel for you, but unfortunately the buyer appetite just isn't there right now. Yeah,
it'll come. Okay, so we've talked about cash buyers, talked a little bit about strategic. Let's talk about private equity groups, or PEGs, as you like to call them. What's happening in that sphere of buyer pool?
Yeah, so PEGs come in different flavors. We've talked at length about this in the buyer videos, but just to recap real quick, anyone can call themselves a private equity group. You can put up a website and say you're a private equity group. That's not the type of private equity buyer we're talking about here. I'm talking about specifically, our favorite is a private equity group that has a portfolio company, a platform company in a vertical, and they're looking to add on to that brand or that company, right? So maybe they're in the cosmetics space and they have infrastructure. They're wanting to add brands onto it. That's one type of private equity group I'm going to talk about. And then there's also those that have raised funds, so they have committed capital from investors that they need to deploy. Both of these we love, because rain, hail or shine, market turning or not, they need to deploy the capital, right? They have a contractual agreement with their investors to get them a better return on their money than they can get elsewhere, right? So they have essentially cash to deploy. They still need to buy good businesses. They're not buying anything. They will buy specifically good businesses, right? So they're still active because they need to deploy the capital. Most of these funds have a 5 to 7 year window where they need to deploy capital, build it up, and exit to return their investors' capital. So at a profit, that's their whole game plan. So they're still very active. And we're seeing more and more of these committed capital funds looking at e-commerce as a potential platform. They're looking for larger deals to create a channel into e-commerce, again, because of consumer behavior. There's also more and more platforms that are looking for online brands to put into their infrastructure and their distribution. So these groups are still very active. And if anything, there's more and more of those coming out all the time.
And are there more first-time acquisitions that you're seeing than before because of people are sort of identifying that there's a consumer behavior change on the horizon, and yes, they're sort of thrust into operating that way? And I suppose the other way, I mean, the way I make sense of it in my mind is that yes, they have capital that they are contractually obligated to deploy somewhere that's going to earn them a good return. And thinking in the e-commerce world that that's kind of where it's going to be, is it also equally because the stock market is where it's not at the moment? Are they, you know, like when you see the stock market crashing and sellers, like these are the types of groups that are pulling money out and then saying, okay, but we still have to do something with it that's going to give us some returns. So where do we put it? We can't hide it in our mattress, so we need to put it somewhere. Is that also happening, do you think, or am I?
That's mostly family offices.
Okay, well, that was the next one I wanted to ask you about, because you know, so is sort of move into like the family office arm of that, and so basically maybe if you could just sort of describe what do you mean by family office, and sort of how are they active in the market, and how has that changed because of COVID?
Yeah, absolutely. So family offices come in many varieties. Typically a single family office or a multi-family office. Essentially, if you sell a company for a bunch of money, you're a movie star like Arnie, for example, and you've made hundreds of millions of dollars in one go or over a period of time. The capital that you have to invest is at a point where it doesn't make sense to use a third-party wealth manager. You can actually employ someone to manage just your capital. So for example, Arnold Schwarzenegger has a family office. He talks about it in Total Recall, and how he got an investment manager to help him with investments directly. So typically there's a pool of cash that they're wanting to deploy at a better rate of return. The private equity model investing in businesses is a very interesting strategy, because historically, or recently as well, specifically, private equity groups have been returning plus 20% for about the last 10 years or so. So getting into private equity, buying small companies, small to medium companies, and building them up and potentially selling them or just holding them for cash flow is a very popular strategy. So there's a few multi-family office, if it isn't obvious, means a couple of families get together, pool their capital, have an investment team managing that cash, right? So that's a single versus multi-family office. Now, they're not all created equal, okay? Often if you hear that the founder of that group or the lead family has X leverage, that's interesting. But it's very uncommon for that family directly to be involved in the management of the cash. So you want to know who's operating the business, what's their strategy, and who do they have in place, right? When it comes to this doing a deal with family offices, the next thing is what's their game plan. So we actually had a call with a family office 2 days ago. They're a multi-family office with operational capability, very strong e-commerce background as the operating partner they have that they're already working with. So this was quite interesting. They were looking at contract manufacturing, acquiring contract manufacturers. So the facilities that make supplements, right, make the ingredients, put them together and send them out. They ran a thesis, investigated that space, and said, actually, they're all kind of the same. Let's look at buying the branded products that they're actually producing for. And now they've switched focus into branded products. They're looking predominantly for supplements or related categories, and they're bringing their leverage to that. So they're active in the market right now. They have a deal under offer. They have the team in place. They have the capital. they've switched focus into branded products and also very interested in e-commerce first because they can bring leverage to outside of e-commerce or Amazon. So definitely more and more appetite from family offices, but it depends, right? I never be impressed if someone says they're a family office or a private equity group. Ask more questions about what they're actually doing. People throw these terms around as, oh, they're a family office. Well, yeah, that's impressive that someone's has a lot of cash to deploy, but what's their actual capability as far as taking your brand to the next level, for example? But on a whole, there's more of them coming into the space, looking at e-com, looking at Amazon-based brands, and that's super exciting. I think we're going to be doing a lot of deals with these guys in the next few months here.
Awesome. Cool. So we've talked about cash buyers, we've talked about strategics, we've talked about private equity groups, we've talked about family offices. Basically, those are the buyer types, and the buyers are still very active, and the e-commerce world is still very attractive, even more so today than it was yesterday. But just to sort of round things out here, the access to debt has changed. So perhaps access to borrowed money to purchase these businesses has changed, stalled, or stopped, I guess, in some cases. But the appetite is still there, and perhaps what that does is change the deal structure, but it doesn't change the deal value, and it doesn't change the activity within the market. Is what did I sort of encapsulate that right?
Yeah, and I think we've turned a corner as far as in the US specifically on the debt side. I think there is more appetite coming back from the debt providers, but that's still early days. But we've definitely seen a dip over the past couple months here. So.
Yeah, absolutely. But I mean, as things start to open up and things, the wheels start to move again, like the shock of all of this is over. You know what I mean? Like, I think at the beginning, people just had no idea how far it was going to go, but now we sort of have. I guess we don't really, but you know what I mean? I guess if people are sort of getting used to the new normal and say, well, we can't stop forever, so where are we going to put our money?
Yes, so, exactly. Yeah. It's like people have woken back up over the past couple of weeks. That's the feedback I'm getting, and that's what we're seeing as well. In fact, in the past 2 weeks, we've had debt providers reach out to us specifically to help fund deals even, which has been quite interesting. You found one of those. So that was kind of awesome.
Those are interesting calls to be on, because you watch all the news headlines and you think, God, everything's terrible. Then you get somebody to call you up and say, hey, I've got a lot of money and I want to help people. And it's, okay, let's talk. Yeah, I don't know. Like, what do you have in mind? Yeah. So it's interesting calls to have, I guess. Yeah, for sure.
Awesome.
Cool. Well, we're just bumping up against our half-hour mark here. So that was great. Thank you for that insight.
Perfect timing. Yeah, this was fun. A fun one to talk about.
Yeah.
So how can
overdue,
people reach out?
Yeah.
Yes. Yeah. How can people reach out to us, Jeff?
Yeah, absolutely. sales@thefbabroker.com is the best email. It comes straight to my inbox. And if you're looking at selling a business now, in the future, exit planning, have some questions about the market, whatever it may be, send me an email and we'll arrange a time to have a call. Even if you're interested in buying, I will point you in the right direction. But sales@thefbabroker.com is probably the best email to use. All right.
Yeah, absolutely. And if you do have more questions on this topic and you're watching the replay of it, drop it in the comments. We'll answer those. If you are looking to sell your FBA business, e-commerce business in the near future, and you want to know how it would be positioned in the market, check out this resource, fbascorecard.com. We've put together a scorecard. It makes it easy for you to compare your business to other businesses that have sold. There's a quick video of me walking you through how to actually implement that in your own business. And this could be a good guide to help you on the way to improving the value of your business when you before you go to sell. And also we have W Exit Community that you can check out as well. It's a Facebook group. We're putting all of the live trainings in there. So yeah, anyway, that's the end. Happy Tuesday to everyone. Have a great week ahead, and thanks for the call, Jeff. We'll see you
Enjoy your
tomorrow.
tacos.
Oh, wait, what's tomorrow?
Oh, yes, tomorrow. What buyers want Wednesday. So we will go through buyer criteria that have been shared with us over the last week. So if you have an FBA business that you're looking to sell, this is your sort of chance to sort of listen in to see exactly what buyers' wish lists are and how and just the things that they're looking for specifically. So interesting topic.
Yeah, so we'll talk about that tomorrow. Awesome. All right, we got that one in. All right, we'll see you here again tomorrow. And thanks, Jeff.
Awesome. Bye for now.